Good morning and welcome to Charting Markets on Monday, the 17th of July 2023. Overnight we had some data out of China, and the second quarter GDP growth came in weaker than expected at 6.3% versus an expected 7.1%. And this was on the back of weak retail sales and also the moribund property sector. And as the exports from China, the second largest economy in the world, were actually lower than expected. And this combined with unemployment for young people between the ages of 16 to 24 rising to 21.3%, a new record high in the last month, put pressure on investors and on stocks in Asia, as they now, or the traders at least, hope that there will be a stimulus package coming out of Beijing at some stage in order to prop out the economy there. But the short-term impact has been that Asian stock markets have actually declined, and we could see some follow-through of that in the European markets as well. In the US, the NASDAQ 100 has risen very nicely over the last few weeks on these lower than expected US inflation readings, both on the consumer side and also on the producer side last week. And if we look at the NASDAQ 100, we can see that we've seen a very nice rally at the end of last week, taking us to 15,722. And today we're slightly coming off here, but what is interesting is from a technical perspective, we still have a series of higher highs and higher lows, which is clearly the definition of an uptrend. And if we were to rise above last week's highs, then the psychological 16,000 mark would be our next upside target, simply because it's a round number and markets tend to gravitate towards those. If, however, a retracement were to be seen to the downside in the course of this week, because let's not forget, we have tomorrow earnings from several major banks in the US out, such as BNY Mellon, Bank of America, Morgan Stanley, I believe, Goldman Sachs. All of those might have an impact on the NASDAQ 100 as well, before Tesla has its earnings on Wednesday this week and kicks off the tech sector with regards to earnings. So what are the technical levels to watch out from the NASDAQ 100? Well, basically last week's high, because if we take that out, as I say, the next target is about 16,000, and the highs seen in June and also at the beginning of July, which come in between 15,283 and 81. So that's really, really good support. And from a technical perspective, provided we stay above the current July low at 14,920, the bull market is still intact. Everything looks fine. If we were to slide through that level, perhaps we would have to reevaluate with regards to the future trend. But above 14,920, that is to say the early July low, things are still looking rosy for the NASDAQ 100. If we now move on to the European markets, we can see that the FTSE 100, after having recovered by nearly 5% in the course of last week on those weaker than expected inflation numbers coming out of the United States, we rallied to 7,481 on this daily financial bet, and then basically failed and have started to come off again very slightly this morning on that weaker Asian session. And we are currently retesting the late June low at 7,401. If it were to be fallen through, there isn't really much support to speak of until we get back down to the 10th of July high around 7,307. And from a technical perspective, basically now that we've bounced off the low seen back in March, which happened with regards to the US retail banking crisis, which then spread and led to European banks such as, for example, Credit Suisse, basically having to be bought out by Switzerland's largest bank, UBS. Well, back then we were at 7,204. Now we've dropped to 7,228, so marginally above the March low, but we've bounced off there since. Still, if you look at it from a technical perspective only, the trend is your friend, and that's still pointing down because we've got lower lows and lower highs, as you can see here on the FTSE 100 chart. So unless we take out the last reaction high, that is to say the current July high, which was made on the 3rd of July at 7,562, and also here you can see the red and orange lines and also the downtrend line coming down from the April highs, all of which come in around 7,580 and 7,586. As long as we stay below there, the momentum is pointing towards further downside being seen. If we were to manage over the next few days and during earnings season in the US to rise above that resistance area, above 7,586, then the FTSE could have a recovery rally over several weeks and months. But for the time being, we are still looking more bearish than bullish on the FTSE 100 on the medium-term perspective. Moving on to Germany. Here we've had an interesting story in that we fell through this key support area going back to the late April lows between 15,710 and 15,625, which took us down to the current July low at 15,455. But since then, on those weaker than expected US inflation numbers, the DAX 40 really rallied quite strongly by around 5% and nearly reached its early July high at 16,211. Just fell short of that at 16,187 last week. Today, what is interesting is that we are falling through what is called an inside day or Harami pattern on the candlestick chart here, which is basically when it happens when you've got a day's candle which falls within the previous day's candle. Let me just make it bigger here to show you. And it could be pointing towards a short-term reversal. So short-term, we might have a technical short-term downside target now around the orange line here, the 55-day simply moving average at 15,980. And perhaps we could even see a slide back to that key support area, taking us back to us 15,710 in case of the current decline being accelerated over the next few days. And as long as we don't take out these recent highs between 16,187 and 16,211. So these are the sort of key levels to watch out for, because if we break above those, then we've got the record all-time high back in play, which is the 16,428 high seen in mid-June on this daily financial bed. But right now, maybe just a short-term consolidation to the downside, which does look likely. Yes, we might just retest the psychological 16,000 mark. Currencies have been impacted by the very sharp depreciation in the US dollar on that weaker than expected US inflation data coming out of the world's largest economy last week. And we can see the impact this has had on some crosses such as euro dollar. And as you can see here, euro dollar has risen so far to around 112.48. And this takes us back to levels traded. I need to go all the way back onto a weekly chart here in February of 2022. And what is interesting here is, can you see the 2020 to 2022 downtrend and bear market here in euro dollar, and the Fibonacci retracement levels, which I have traced on this. And interestingly enough, at 112.80, we've got the 61.8 Fibonacci retracement, which is a really important Fibonacci retracement for technical analysts. And that is our next upside target for euro dollar. And if we were to manage to break through there, I actually expect some consolidation to be seen around that Fibonacci retracement. But if we were to manage to break through that, close above it on a weekly closing basis, then the way is opened for the 115 area to be reached. And basically that brings us back to levels last seen in January of last year between 114.82 and 114.95, so very close to this psychological 115 mark. So this is the story for euro dollar. If we go and look at cable, the British pound against the US dollar, you can see here also a very nice acceleration to the upside, taking us to levels last traded in April of 2022. And here we are heading, now that we are trading above the psychological 130 mark, back up to the December 2021 low and 132.89. So that would be our next upside target. We're pretty close to there. And if we were to manage to rise above 132.89, the next upside target is the late March 2020 high and this came in at 132.98, so basically the 133 handle. And as you can see here, we've had 6 consecutive days of rising prices for the British pound against the US dollar. This is now being followed by a minor retracement, but it really is minor. It's doing no damage whatsoever to this uptrend. And provided we basically stay here above 128.48, the June high, for me, technically things would look very, very bullish. And for the picture to change from a medium-term perspective, from a technical basis, we would have to fall all the way through the June low, the late June low at 125.91, and we're a long way from there. So I expect further upside to be seen, and I would buy into dips into this currency pair as the US dollar is likely to weaken further in the weeks and months ahead. And we can see that this has also had an impact on the Japanese yen. As you can see here, we went from a multi-month high at 145 yen and 7 cents all the way down to 137 yen and 25 cents, just marginally above the red line here, the 200-day simply moving average at 137.01, and that was last Friday. We held there. Short term, we're holding above this support area, the 200-day simply moving average, and that low, that 2-month low that we made last Friday. We would have to take out Friday's high at 139.15 for a minor bullish reversal to be seen, but even then there's a lot of resistance on the way up, and you've got the orange line here, the 55-day simple moving average at 139.69, and then the psychological 140 area, which is also another possible upside target. But basically, provided we stay below the May high at 140.93, things do not look very rosy for dollar yen, and I would expect a short-term recovery in this currency pair to be followed by another down leg. The weaker US dollar has had a very strong impact on a lot of commodities, which rallied quite strongly last week, one of which is the price of gold. And if we look at spot gold, as you can see here, we have recovered quite nicely from just below the psychological $1,900 per troy ounce level, which we hit back at the end of June, and have now risen to the orange line here, the 55-day simple moving average at $1,961, and basically made a small high last week here on this daily financial bet at $1,963. This would need to be taken out for us to be heading back up again towards the June high at $1,983. But that is a pretty important resistance area, so it might again cap. And if it were, however, to be taken out, then we could head back up again towards the psychological $2,000 mark and also towards the March high at $2,009. But right now we're struggling slightly around this orange line, the 55-day simple moving average, and we may see a short-term retracement lower. But there is pretty good support coming in now around the early July highs, around $1,935, and also the late May lows at $1,932. So that whole area between $1,935 to $32 should provide pretty good support, and perhaps it might make sense to buy any short-term dip in the price of gold to add to longs. Moving on to crude oil. I mean, the price of crude oil has risen quite sharply over the last 3 weeks. We had a 3-week high, and actually no, a 2-month high after a 3-week gain, which came on the back of OPEC Plus basically cutting supply by nearly 5.5 million barrels a day now, and Saudi Arabia cutting its output voluntarily by 1 million barrels a day and extending that output cut to the end of August. And this is also followed by Russia, which has also cut its outputs in the course of July by 500,000 barrels, I should say, per day. And that rally has taken us, interestingly enough, to the red line here, the 200-day simple moving average, which once again capped the upside in crude oil. As you can see here, WTI topped out at $77.17, which is marginally above the red line here, the 200-day simple moving average. And can you see here what happened back in April? We hit it and then we came all the way back down again. Now, I'm not saying that this is likely to happen, but short term it is starting to happen. So we'll have to see whether we can now hold at this 3-week uptrend line, or support line I should say, around $74, because if we don't, then we'll likely retest the late June high at $72.70. And below there, we've got this sideways trading range we had been trading in for the last 3 months, since the beginning of May. between $74.70 and around the $67 mark at the bottom. So it'll be interesting to see whether we can hold at that support line. As long as we do, we might have a retest of the 200-day simply moving average and then head back up again towards the psychological $80 area. But if we do fall through that support line, then it's quite likely that we're going to head not just down towards the late June high, but also towards the orange line here. This is the 55-day simple moving average at $71.46. So interesting to see this. And don't forget, we had this negative candle on Friday, right at the 200-day simply moving average. So yes, short term, the momentum belongs to the bears. And the story is quite similar with regards to copper prices. I mean, copper last week rallied also very strongly on that weaker US dollar, but as the dollar remains weak, copper is actually coming off on this weaker than expected data out of China, the global economy's second largest economy. And basically growth for the second quarter of this year in China came in weaker than expected, 6.3% compared to the previous year. And it was expected to come in at 7.1%. Now, it did still rise by 0.8% compared to the previous quarter, but the growth was less than expected. And this has led basically to the risk off sentiment and commodity prices also coming off on the back of that, because if a big importer of copper, for example, such as China, is no longer showing strong demand for the metal, for the commodity, I should say, then basically that can have a negative effect on the copper price. And as you can see here, we've come all the way back down again from the $8,718 per ton high we made. That was basically a near 3-month high back last week, to now retesting the red line here, the 200-day simply moving average at $8,473. And it seems to look like a strong downward candle being formed at the moment, which would maybe take us down over the next few days to also the orange line here, which is the 55-day simply moving average at $8,361, and also the May-July uptrend line around $8,276. So these, for me, technically are the short-term downside targets, and then we'll have to see whether we can hold there or not, because if we don't, then we could be heading back down again towards the late June low at $8,142. And this is the critical level to watch, because if that gets taken out, what we have seen since the May lows might just be an Elliott wave zigzag correction to the upside, and it could spell the continuation of the previous downtrend that we've seen since last year in the price of copper. So really important to watch out for that level. So on the downside, as I said, $8,142, and on the upside, $8,718, because if we were to take out that high, we could then be heading back up again towards the $9,000 mark, and also the highs seen back in March and also in April, taking us all the way back up again towards $9,182. But short term, the worries to do with China, and as long as China basically doesn't, or Beijing doesn't, provide a new stimulus package to prop up its economy, then the weaker growth we are seeing at the moment seems to be indicating lower commodity prices in the short term at least. Thank you very much for watching Charting the Markets with me, Axel Rudolph. Please feel free to follow me on Twitter. My Twitter handle is @AxelR_IG.